Gold and silver are often the first refuge when markets turn uncertain. But after a massive rally in precious metals, experts are now warning that many investors may have become too heavily exposed to them. Interestingly, this debate comes just as Prime Minister Narendra Modi urged Indians to avoid buying gold for the next year amid concerns over imports and pressure on India's external balances. So now the big market question is this: after the sharp rally in gold and silver, should investors book profits and rebalance their portfolios? And if yes, where should that money go? Equities, debt, or should investors remain bullish on precious metals? Let's understand in this episode of Markets This Week. Over the past year, gold and silver have outperformed both Indian equities and debt. Several factors drove the rally: global uncertainty, a weaker US dollar, aggressive central bank buying, and rising fiscal stress across developed economies. Another important driver has been real interest rates. Now, when real interest rates fall, gold tends to become more attractive because investors look for safer stores of value. But experts say that does not mean investors should keep increasing exposure indefinitely. This is what has happened in many portfolios. Because gold and silver outperformed equities and debt, many investors are now unintentionally overweight on precious metals. That is known as portfolio drift, and experts warn it can increase concentration risk. Most advisors recommend limiting gold exposure to around 10 to 15% of a portfolio and silver to roughly 5%. Beyond that, portfolios can become excessively dependent on one asset class. The Indian equity market has largely remained range-bound since mid-2024. Valuations had become stretched while earnings growth slowed. Lower inflation also meant companies depended more heavily on volume growth, which pressured margins and profitability. Large cap funds have underperformed over the past 12 months, but analysts say there is now a case for cautious optimism. After recent corrections, large caps and select cyclical sectors appear more reasonably valued. Mid and small cap stocks have delivered stronger one-year returns than large caps, but experts caution against chasing momentum blindly. Some pockets still look expensive and parts of the mid-cap space could see time correction. So the focus, analysts say, should now shift towards stock selection and discipline rather than momentum-driven investing. In the near term, equity markets will continue to depend heavily on crude oil prices, global cues, and foreign investor flows. Debt markets are facing pressure as well. Higher crude prices, a weaker rupee, and monsoon-related concerns have pushed inflation expectations higher, lifting bond yields. Now that creates risks for long-duration debt funds. However, accrual levels have improved. Experts currently prefer debt funds with portfolio maturities of around 2 to 4 years. The key advice is to align investment horizons carefully with the type of debt fund being chosen. Gold had a strong run, silver followed closely. But markets do not move in straight lines and portfolios should not either. Experts say this may be the time to trim exposure, lock in some gains, and gradually rebalance capital across equities and debt. Because diversification, not concentration, remains the foundation of long-term investing. Follow Business Standard for more stories on markets and the economy.